So let's talk about Warren Buffett. We're going to break down the timeless wisdom of one of the greatest investors ever. But here's the secret. His most powerful lessons, they didn't actually come from him. Nope. They came from a single book that completely changed the course of his life. That's what Buffett himself said about Benjamin Graham's book, The Intelligent Investor. I mean, he read it when he was just 19 years old, and it laid the foundation for his entire career. When a recommendation is that strong, you kind of have to pay attention. Most of us think investing is about finding some secret formula, right? Or trying to predict what a stock is going to do next week. Well, this book argues that's completely wrong. It's not about a crystal ball. It's about building a framework, a way of thinking about money and risk that protects you from making those huge, catastrophic mistakes. So what does this framework actually look like? Well, it's built on 5 core principles from that legendary book. These are the rules that can help you invest intelligently and, honestly, save you from a world of financial pain. Let's dive into the first one. Okay, this first rule is built on maybe the most famous analogy in all of finance. To really get the stock market, Graham asks you to imagine that you have a very peculiar business partner. Let's call this partner Mr. Market, and he is completely driven by his emotions. One day he's euphoric, the next he's terrified. There is no in-between. Every single day, he shows up at your door and offers to either buy your shares from you or sell you his at a totally new price that's based on whatever mood he's in that morning. And this pretty much sums him up perfectly. Imagine you own a simple coffee shop. On Monday, Mr. Market bursts in, practically shouting with greed, offering you $1 million for it. The very next day, he shuffles in, crippled by fear, telling you coffee's a dying industry and he'll only give you 50 grand. Would you take him seriously? Of course not. You'd think he was crazy. And here's the real key. Mr. Market is there to serve you, not to guide you. His panic, that's your opportunity to buy great companies at a huge discount. His euphoria, that's your chance to maybe consider selling at ridiculously high prices. The goal is to use his irrationality to your advantage and never ever let it dictate your own actions. All right, so once you understand Mr. Market, the second rule forces you to define yourself. Graham argues that you absolutely have to know if you're an investor or if you're just a gambler, what he calls a speculator. And believe me, the two are worlds apart. An investor does the deep research. They focus on protecting their initial capital first and foremost, and they're aiming for a satisfactory, reasonable return over the long haul. A speculator, on the other hand, is chasing tips, buying on hype, and basically just hoping some, quote, greater fool will come along and pay more tomorrow. It's the difference between buying a house to live in versus trying to flip it in a week based on a rumor. This forces a massive mindset shift. You're not buying a ticker symbol that wiggles around on a screen. You are buying a small piece of an actual company with real people, real products, and real problems. The ultimate test is this. If you wouldn't be comfortable owning the entire business, you probably shouldn't be buying even a tiny piece of it. Okay, so if you're an investor, not a speculator, how do you protect yourself? This brings us to rule number 3, the absolute bedrock of risk management, the margin of safety. It's a really simple concept that protects you from the one thing nobody can predict, the future. So here's how it works. First, based on all your research, you figure out what you believe a business is truly worth, its intrinsic value. Let's just say it's $50 a share. But you don't buy it at $50. No, you demand a significant discount to that price. You wait until Mr. Market has one of his bad days and offers it to you for, say, $30. That 40% discount, that's not for extra profit. That is your room for error. It's your cushion. It protects you if your analysis was a little bit off, or if the company hits a rough patch, or if the whole economy just takes a nosedive. It's your built-in safety net. And this analogy just makes it crystal clear. You would never build a bridge that can only handle the exact weight of the trucks crossing it. That would be insane, right? You over-engineer it for safety. You build it to handle way more. And you have to do the exact same thing when you buy a stock. Remember, a great business at the wrong price is a bad investment. Patience is everything. This idea of safety builds directly into rule number 4. See, Graham was really clear that there are 2 valid paths for an intelligent investor, and the key is that you have to choose one. Trying to be somewhere in the middle, well, that's where people get into a lot of trouble. First, we've got the defensive investor. Think of this person as a casual gym goer. They aren't trying to become a professional bodybuilder. They just want to stay healthy, avoid getting hurt, and get consistent results with minimal fuss. So the defensive strategy is simple, and honestly, it's super effective for most people.
You buy the whole market through low-cost index funds, you invest the same amount of money on a regular basis no matter what the headlines say, and then you basically just leave it alone. It's boring, for sure, but boring is what builds wealth.
Now, on the other hand, you have the enterprising investor. This is your serious athlete. They've got a detailed game plan, they put in the hours, and they are actively trying to outperform everyone else. This is the path a young Warren Buffett took. Being enterprising means you are willing to do the hard work of analyzing individual companies to find those margin of safety opportunities. This isn't a hobby. It's a serious commitment of time and skill. And Graham's warning is pretty blunt. If you're not willing to put in that kind of effort, just stick to the defensive approach. But here's the thing. Whether you choose the defensive or the enterprising path, none of it matters without this final rule. This is the glue that holds everything together, and it has way less to do with finance and a lot more to do with psychology. Just look at this timeline. Markets crash. It's just what they do. We saw it with the dot-com bust, the 2008 financial crisis, the COVID crash. In every single one of those moments, fear completely took over. People panicked, and they sold at the absolute worst possible time. But in every single case, the market eventually recovered. The winners were the ones who controlled their emotions. This is why Graham's point is so powerful. Success in investing has very little to do with your IQ. It's all about emotional discipline. You can be the smartest person in the world, but if you panic during a crash or get greedy during a rally, you're going to lose. Your temperament is so much more important than your intellect. Look, you can't control Mr. Market. You can't control the economy. You can't control world events. The only thing you have 100% control over is your own behavior. And that's why having a solid plan and the discipline to actually stick to it is your ultimate advantage. And that leaves us with this one last really crucial question. Are you just focused on building a portfolio of stocks? Or are you building a system of rules and habits to protect you from your own worst instincts, your own fear and greed? Because in the end, that system is going to be the most valuable asset you ever build.